Hi everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories inside company reports with a smirk and a spreadsheet. Today we're diving into Grey Media's latest filing, which is all about debt, money, and a bit of refinancing magic. So Grey Media Inc. is basically telling us they've been busy making some big financial moves. Think of them as a company that needs cash to keep the lights on running their operations and maybe grow. To do that, they often borrow money. This report is all about a new type of loan they took out, a big one actually, and how it ties into their other loans and how they plan to pay them back. It's like a financial juggling act, and this filing is showing us how they're trying to keep all the balls in the air, or in this case, how they're restructuring their borrowing to make it work. The main event here happened on July 18th of last year, 2025. They've entered into what's called an indenture, which is basically a fancy contract for a loan. This particular loan gives them $900 million. That's a lot of zeros. And it comes with an interest rate of 9.625%. Now, these aren't just any notes. They are senior secured second lien notes. That means they're serious about getting their money back, and they've got a claim on some of the company's stuff if things go south, but not the very first claim. These notes are due in 2032. They got this money by selling these notes and pretty much got the full value for them. That's what's meant by issued at par. So what are they doing with all this new cash? Well, it's going towards paying off some of their old debt. Specifically, they're using it to pay back all of their 7% senior notes that were due in 2027. They're also paying back some of a different loan, a term loan that was originally due in 2029. And of course, like any big financial transaction, there are fees and costs involved in borrowing this money. Now, this indenture comes with rules called covenants. These rules limit what Grey Media can do. They also have limits on how much money they can pay out to their shareholders as dividends or other distributions. And when they deal with companies that connect to them, like subsidiaries or parent companies, there are rules for those deals too. They can't just sell off pieces of the company without following certain procedures. And if they want to merge with another company or sell pretty much the entire business, they need to make sure they follow the rules here too. Like any loan agreement, this indenture has what are called events of default. The most obvious one is if they miss a payment, or if they break any of those rules we just talked about. And of course, if the company goes bankrupt or becomes unable to pay its debts. If one of these default events happens, the lenders can demand all the money back immediately, which is called acceleration. So when is all this money due back? The notes mature on July 15, 2032. That's quite a long time from now. Interest starts adding up from July 18th of last year, and they'll be paying that interest twice a year on January 15th and July 15th, starting in January 2026. Grey Media also has the option to pay back these notes early, starting after July 15th, 2028. And they can even pay back up to 40% of the loan early if they do it before July 2028, but they'd have to pay a bit extra, 109.625% of the face value. And this is usually if they raise money by selling stock instead of debt. Also, if they sell off certain parts of a company, or if there's a big change in who owns or controls the company, they have to offer to buy back these notes. So what does this mean in the grand scheme of things? These notes and any guarantees are considered senior secured second lien debt for Grey Media and its guarantors. This means they are equal in priority of payment to other existing and future senior debts. They're not pushed to the back of the line. However, they are effectively a step behind any debt that's secured by assets that aren't specifically tied to these notes. Imagine if you have a first mortgage on a house and someone else has a second mortgage. Those with first mortgages get paid first from the sale of that house. And importantly, any debt that has a higher ranking lien on the same collateral will get paid before these second lien notes. Now, switching gears a bit, there's also a change to their main loan agreement called the Senior Credit Facility. They've entered into a Fifth Amendment to this agreement. This amendment is good news because it increases the amount they can borrow from their revolving credit facility by $50 million. So now they have a total of $750 million available to borrow as needed. They've also pushed back the deadline for repaying this revolving credit line by a year, moving it from 2000 to 2028. The interest rate on this revolving credit is tied to SOFR, a benchmark interest rate, and it can range from OFR plus 2.75%. The exact rate depends on something called the first lien leverage ratio, which is basically how much debt they have compared to their assets or earnings. They also have to pay a fee on any of that $750 million that they don't end up borrowing. This is called a commitment fee. It's also worth noting that Wells Fargo, the bank handling a lot of this, and other financial institutions involved have had and likely will continue to have various business dealings with grey media, providing things like cash management and investment banking services. That's pretty standard in the industry. And by entering into these new debt arrangements, they've essentially created new financial obligations for themselves. Then we have some other events which are basically announcements about these deals. Grey Media announced the closing of their $900 million note offering through a press release. They also announced the closing of that Fifth Amendment to their credit facility. This last part just lists all the documents that back up everything we've been talking about. This includes the actual indenture document itself, which is the big contract for the $900 million loan. And then there's the specific form of those 9.625% notes. We also see the Fifth Amendment to their main credit agreement, and the press releases that officially announce these big financial moves confirming everything is done. Finally, the signature block shows us that Jeffrey Argignac, who is the Executive Vice President and Chief Financial Officer, signed off on all of this, confirming it's all official. So let's talk about what this all means for Grey Media. They've taken on a significant amount of new debt with these $900 million notes. The interest rate of 9.625% is not insignificant, especially when combined with the fact that it's a second lien, meaning there are debts senior to it. This strategy of paying off older, likely more expensive or less flexible debt with this new financing suggests they are trying to optimize their capital structure. The increase and extension of their revolving credit facility is a positive. It gives them more flexibility and a longer runway to manage their short-term cash needs, which is always a good sign for operational stability. However, the entire move hinges on their ability to manage this increased debt load and ensure they can comfortably meet those interest payments and the eventual principal repayment. One of the key risks here is the interest rate environment. If interest rates continue to rise, the cost of servicing this debt could become more burdensome. Also, the covenants within the indenture, while common, do put constraints on their strategic options. They need to be mindful of these limitations as they plan for the future. From a Warren Buffett perspective, you'd want to see if this debt is being used to fund profitable growth opportunities, or if it's simply to keep the lights on or refinance existing obligations without a clear path to significantly enhanced earnings. The fact that they are paying off older debt is a sign of proactive financial management, but at this higher interest rate, they need to ensure that the underlying business is generating strong cash flows to cover these new obligations. For Grey Media, the direction seems to be one of extending their debt maturities and securing more flexible borrowing capacity. The strength lies in their ability to access capital markets, even for large sums. The weakness could be if their revenue and earnings growth doesn't keep pace with their debt servicing obligations, or if the underlying business faces unexpected headwinds. A clear conclusion is that Grey Media is making a strategic refinance. They're trading some older debt for newer debt with a longer lifespan, which can be a smart move if managed diligently. The key now is execution. Can they grow the business to comfortably support this new debt structure? The increased credit facility is a good sign of operational resilience, but the higher interest on the new notes is a point of attention. Alright, that's our breakdown of Grey Media's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.